Welcome back. In a piece in the Financial Times, our next guest makes the case for why it is exactly the wrong time for the Fed to be cutting interest rates. Ruchir Sharma, chairman of Rockefeller International, joins us now. What a party pooper, Ruchir. Everybody is getting excited about this rate cut next week.
Well, the rate cut is going to happen anyway. But I just want to put this in perspective, Sarah, which is that the Fed has never cut interest rates, let alone start an easing cycle, when financial conditions have been this easy. Typically, the Fed is known to cut interest rates when the stock market's falling, credit spreads are widening, there's some financial market dislocation. This time, we got credit spreads close to record lows. The stock market's obviously very ebullient given the valuations. We have an AI mania building up as far as the market's concerned. And in this environment, for the Fed to be cutting interest rates would be pretty unprecedented. So I think that's the main perspective that I've tried to provide in this op-ed today. And in the past, when the Fed has cut interest rates, when the economy's been doing okay, it has usually been a recipe for a bubble. That's what happened in 99, 2000. And some will argue that that's what, possibly even happened in 2021. But I think the main issue here is the fact that financial conditions are super easy. The Fed has never cut interest rates when financial conditions have been this easy.
Yes, but I would argue that financial conditions are not its mandate. Yes, it's a transmission mechanism, but the mandate is stable inflation and maximum employment. And there's some worrisome signs on the jobs front, and so they want to get ahead of it and cut rates.
Yeah, but I think the Fed is overly focused on the labor market. As far as inflation is concerned, the Fed has missed its inflation target for 5 years in a row. Even before the tariff effects took place, the Fed's the inflation rate was sticky at around 2.5% or so. Now we are looking at a rate closer to 3%, and it's likely to stay that way for the foreseeable future. And as far as the economy is concerned, most estimates suggest that this quarter, the economy is bouncing back. It's likely to grow at above 2% again. So I think that just to narrowly focus on the labor market, and even the labor market, the unemployment rate is still 4.3%, and they want to get ahead. But that's the problem, which is that the Fed always tends to have this bias for easy money, and that it focuses on whatever's the one reason it should cut interest rates. Whereas I'm trying to sort of say that if you look at the whole picture, including the mandate that you speak about on inflation, the inflation rate is well above the target, and it's missed it for 5 years in a row.
But it has come down a lot, and they were cutting when it was higher last year.
Yes, that's right. But there's no evidence, that's the point I make, that the monetary policy is being restrictive. We don't know what the neutral rate is given how fiscal policy is. The fact that you're running a fiscal deficit today of 6.5% of GDP, that's very stimulative as far as the economy is concerned. We don't know what the neutral rate really is, because the fact of the matter is that if the Fed funds rate is 4.5%, the nominal GDP growth is still well above that at 5 to 6%. So I don't see any evidence of how monetary policy is being restrictive. So I'm not saying the Fed should necessarily hike interest rates.
A lot of people would point to housing on that front.
And on housing, I make the point in the piece as well. The main reason that the housing market is seeing such elevated prices is because of a supply shortage. There's no supply on the housing market. The fact that housing starts are at the same level as they were 40, 50 years ago tells me there's a real problem with housing. So in that regard, I think the real agenda to unlock the housing market needs to be deregulation rather than what to do with mortgage rates.
Well, I think they're still high. But either way, I highlighted this op-ed today from the Wall Street Journal from Ken Griffin of Citadel, who raised questions about credibility in U.S. assets. He talked about Fed independence, but he also talked about White House pushing the Fed to cut at a time where there's still inflationary risks, and that could be a problem for credibility and for U.S. interest rates. Do you feel like we're in that territory?
Yeah, but the point I make in this piece is that this is not so much about Fed credibility and independence, but in fact, I had some sympathy with the argument that the Fed does need reform. That this whole idea that the Fed has done such a fantastic job for the last 20, 30 years and the Fed should be left alone. No, I do feel the Fed should be held accountable for its mistakes. But in my book, those mistakes have had to do with easy money, not to do with the fact that the Fed is being pushed now into cutting interest rates more. even without pressure from the Trump, the Fed's been far too dovish, has been my argument. And it's the real reform that the Fed needs is to deal with its mission creep, something that Secretary Scott Bessent also spoke about in a recent piece. But I'm really surprised by how many people on Team Trump have now flip-flopped, that they used to criticize the Fed for being too easy, for stoking financial market bubbles, for promoting wealth inequality with their easy money policies. And here they are with the economy, they claim, doing just fine. And yet they're calling for lower interest rates and pretty aggressive rate cuts. I don't see the case for that, given how nominal GDP is performing.